I'm Anna, the top women trader in the world, and I assist inexperienced traders in generating profits. In this video, we'll discuss ETFs and index funds for beginners. See you after the intro. Good morning, traders! Before we dive into this ocean of knowledge about ETFs and index funds, I have something important to tell you. If you want to see how to put all these great theories we're about to discuss into practice, don't forget to check out my courses. There, you can observe how I trade on stock indices and commodities. It's like sitting next to me as I try to tame these financial bulls and bears, but without the risk of me stealing your coffee. Now, get ready, because I'm about to blow your mind. What you are looking for isn't long-term trading, it's income. Boom. I know some of you are thinking, what the hell is she saying? But trust me, you'll understand everything in the end. It's like when in 1992 they told us that the internet would change the world. At first it seemed absurd, but look where we are now. Remember, when people laughed at the idea of buying books online? Well, now Amazon is worth more than GDP of many countries. So what's an ETF? Think of a shopping basket full of stocks. It's like buying the entire supermarket instead of a single product. Imagine you want to invest in the tech sector. Instead of buying Apple, Google, Microsoft stocks separately, you buy a tech ETF and voila! You have a price of all these companies in one go. It's as if in 1980 you could have bought a piece of all the companies that would become tech giants instead of having to guess which would be the next Apple. Think if you had to choose between investing in Apple or Commorate in 1980s. With an ETF, you would have had both, and Apple's success would have more than compensated for Commodore's failure. And index funds? They are just like the twin brothers of ETFs, but with some differences. Think of them as a big cake made of slices of different companies. The main difference? ETFs are bought and sold like stocks during the day, while index funds are only traded at the end of the day. It's like the difference between fast food and a restaurant. One is faster, the other more traditional, but both fill your belly, your portfolio. The first index fund was launched in 1976 by Joe Bogle, the founder of Vanguard. At the time, the idea of a fund that simply replicated an index instead of trying to beat the market seemed crazy. Experts called it un-American and predicted it would fail. Spoiler alert, not only did it not fail, but it revolutionized the investment industry. Why should you be interested? Well, there are a lot of reasons, and believe me, they are juicier than a well-cooked steak. First, diversification. It's like having a buffet instead of a single dish. If one company does badly, others can compensate. Think about what would have happened if you had invested everything in Kodak in the 90s. You'd be in trouble. But with an ETF, you would have also had companies like Amazon that have more than compensated for the losses. It's like not putting all your eggs in one basket, but having an entire chicken coop of hens laying golden eggs. Second, low costs. More money in your pockets. ETFs and index funds have much lower fees compared to actively managed funds. It's like buying at the market instead of luxury stores. The quality is the same, but the price is much lower. Think that in the long run, even just 1% less in fees can translate into tens of thousands of euros difference. It's as if every time you buy a coffee, someone gives you a euro. It doesn't seem like much, but after 30 years, you can buy yourself a villa. Third, transparency. You know exactly what's in your basket. No surprises, no tricks. It's like having a detailed recipe instead of a mysterious dish. You know exactly what you are eating financially. Remember the urine scandal of 2001? With ETFs, you would have known exactly how much your wealth was tied to that company. It's like having X-rays for your portfolio. Fourth, accessibility. You can start with just a few coins. You don't need to be Scrooge McDuck to start investing. With ETFs, you can start your journey to wealth even with the cost of a pizza and a beer. Think that 1976, when the first index fund was launched by Vanguard, it took at least $10,000 to start. Today, you can start with $50. It's like they give you the keys to a Ferrari and tell you that you can drive it by paying only for parking. But how do we do it? Here are the steps to follow, and I promise it's easier than a sense of IKEA furniture. First, define your goals. Do what you want to get rich quickly or plan for the future. Spoiler, get rich quick almost never works. Think long-term as if you were planting a tree. Do you want shade for next summer or a forest for your grandchildren? Warren Buffett once said, someone sitting in the shade today because someone else planted a tree a long time ago. Be that someone who plants the tree. Second, choose the right ETF. There is one for every taste. Want to invest in technology? There are ETFs for that. Prefer renewable energies? There are ETFs for that too. It's like choosing an ice cream flavor. You're spoiled for choice. Think that today there are ETFs that follow the trend of everything, from stocks of companies that produce cannabis to those that deal with artificial intelligence. It's like having an endless menu of investment opportunities. Third, think long term. Don't panic if the market has some ups and downs. It's like being on a ship. There will be waves, but in the end, you will reach your destination. Think about the crash of 1987, when the Dow Jones lost 20% in a single day. Those who sold in panic lost everything. Those who held on recovered completely in less than 2 years. Or think about the 2008 financial crisis. The market lost more than 50%, but those who held on saw their investment more than triple in the following 10 years. Fourth, monitor but without obsessing. You don't need to check it every 5 minutes. A monthly or quarterly review is more than enough. It's like taking care of a plant. Water it regularly, but don't stand there watching it grow. Peter Lynch, one of the greatest funds managers of all time, once said, "Growing trees requires fertilizer and patience. Even the best investments require patience." Now, a personal advice. If you have less than $1 million to invest and you are young, forget about bonds. Go full stock. And when I say stock, I mean S&P 500. It's like betting on the entire American economy. Think about it. It includes the 500 largest companies in the United States. It's like having a piece of Apple, Amazon, Google, and all other big companies once in one go. Look at ETFs that replicate the S&P 500 and distribute dividends. Yes, you might pay a little more in taxes, but trust me, there is something magical about receiving money regularly, without lifting a finger. It's like having a money tree in your garden. Imagine receiving a check every 3 months, just for making a smart choice. Isn't that fantastic? It's like being paid to breathe. Remember, investing doesn't have to be complicated. Don't worry about beating the market or being the smartest person in the room. The goal is to create a steady income stream over time, without going crazy. It's like planting a seed and watching it grow. Instead of trying to guess which will be the next most beautiful flower in the garden. Warren Buffett, one of the greatest investors of all time, has always preached simplicity. And it works for him. Why shouldn't it work for us? And if the market crashes, buy. And if it crashes even more, keep buying. It's like a summer sale. The lower it goes, the better the deal. Remember, I said 12% average annual return. This will be years of loss, but in the long run, everything will go up. It's like a roller coaster. There are breathtaking descents, but then you always go back up. Think of all the crises we've been through. The dot-com bubble, the 2008 crisis, the pandemic. Every time the market has come back up, stronger than before. Let's take the 2008 crisis as an example. The stock market lost more than 50% of its value. It seems like the end of the world, right? Well, those who continue to invest regularly during that period made a killing. Imagine buying stocks at half price. It's as if the whole supermarket was 50% off. Now you're probably wondering, if it's so simple, why doesn't everyone do it? Because it's boring and requires consistency. It's like eating vegetables every day. We know it's good for us, but how many people actually do it? Most people look for excitement, the big hit. They want to tell their friends they made 1000% with some obscure cryptocurrency. But you know what? Real wealth is built slowly, with patience and discipline. Think about this. If you had invested $1,000 a month in the S&P 500 starting from 1919, today you would have more than $2 million. Yes, you heard right, 2 million. And this includes all the crises, crashes, burst bubbles. It's like planting a seed and ending up with a forest. But beware, not all of the glitters is gold. ETFs and index funds also have risks. For example, if you invest in an ETF that replicates a single sector, you're exposed to the risk of that sector. Think of an oil ETF during the 2020 pandemic. It crashed. It's like putting all your eggs in one basket, made of oil. Moreover, ETFs can be subject to what's called tracking error. In simple terms, it means that ETF might not perfectly replicate the index it's trying to follow. It's as if you were following someone in a car. Sometimes you might be a little bit closer, sometimes a little bit farther away. Let's not forget about currency risks. If you invest in ETFs that replicate foreign indices, currency fluctuations can affect your return. It's as if you were playing at two tables simultaneously, the stock market and the currency market. But don't let these risks scare you. They're like monsters under the bed. They seem terrifying until you turn on the light and realize they're just shadows. With the right knowledge and strategy, you can manage these risks and make them work in your favor. Guys, that's all. I hope this chat has opened your eyes on how to create real passive income. It's not glamorous, it's not exciting, it won't make you feel like the wolf of Wall Street, but it works. And in the end, isn't what just matters? Would you rather be rich or look rich? Because I assure you, there's a big difference. So what are you waiting for? Start today. In 10 years, you will look back, wonder why you didn't start earlier. It's like planting a tree. The best time to do it was 20 years ago. The second best time is now. And if you really want to understand how I handle these situations in daily practice, my courses are just what you need. I'll explain exactly how to recognize signals on the charts and stock, indices and commodities, how to set up proper money management, and how to protect your capital. You'll get an in-depth look at how to apply these strategies in the real world with practical examples and real trades. Think about where you could be in a year if you start learning the right strategies today. I look forward to seeing you in my courses, where you'll learn all these techniques in detail and much more. It's time to move from theory to practice. Happy investing to all, and remember, the market goes up and down, but in the long run, it always tends to go up. So fasten your seatbelts, prefer your ETFs, and enjoy the journey towards financial freedom.